Hey everybody, good to be here today. My name is Brent Moore. It's time for swing trading. I'm actually sitting in for Mr. Mike Fairborn today, who's a little under the weather, but he should be back shortly. I'm sure probably likely tomorrow, although I can't make any guarantees on that, I guess. But I'm glad to be here. I'm glad to be alongside Barb Armstrong, who's helping me out in the chat too. She's very familiar with what we're going to be covering today. So if you have questions, feel free to lob those our way. We'll do our best to get those questions answered. You can follow me or Barb on X at BrentMooreCS, at Barb Armstrong CS for some additional content there. And what are we talking about today? I want to focus on the basics of swing trading and how reward to risk ratios play into that approach. Okay, so that's going to be our goal, and we'll look at different examples. And I always encourage you in your paperMoney account to practice. You can do some of these trades if you want in paperMoney. These aren't recommendations, but the information today is for general purposes only. It's not a recommendation of a particular security strategy or chart type. And we may look at some options today. Options do carry a high level of risk and are not suitable for all investors. And we're going to discuss technical analysis today. Quite a bit of that, in fact, but that's not the only approach to investment research. You may consider many other approaches, including fundamental analysis or just probability analysis. There's other ways to do it. paperMoney application. We'll be using the thinkorswim desktop software, and it is for educational purposes only that we're going to do today. And I'm not going to factor in commissions on like those option trades. There may be commissions, fees. I'm not going to factor that in, but that is something just to be aware of and pay attention to in your trading. All investing does involve risk, including risk of loss. With stop orders, they don't guarantee an execution at or near the activation price. Once activated, they compete with other incoming market orders. Past performance is no guarantee of future results. Good to see some familiar names there and some names that aren't so familiar. And if you're watching on a recording, that's great too. We're glad to have you. This is the thinkorswim desktop platform. And as I mentioned, I want to talk about rewards and risks. And for the most part, what I want to talk about today is I want to talk about it in regards to trading stocks and perhaps a single leg option trade. And the point is this: we want to have more potential reward expected than what our potential risk is. So for example, if we buy a stock at, I'll make the math easy, buy a stock at $100, and we think that stock may swing up to $110, that's a $10 potential reward there if we were to exit ourselves at that $110 level. But if the stock were to go down and say we set a stop loss at $80, we'd be expecting to lose about $20 if it goes down. That may not make sense. We're risking a lot more than we are potentially gaining. Now, the truth is with stop orders, they're not guaranteed. I already mentioned that once. There's a second time, and I'll probably mention it again. They're not guaranteed, but it is going to be what what our anticipation is of when we're setting up the trade, how we want to set up that trade. So when we're doing swing trades, very often traders will use stop orders and very often will use target orders. And by doing that, by looking at the difference between your stop order and your entry price. So our entry price and our target order, there's a certain distance there between those. And our entry price and our stop order, there's a certain difference between those two. This represents our anticipated risk. This represents our anticipated reward. Generally, what traders often like to do is they like to see rewards greater than risks. And for the purposes of this class, I'm going to say for this class, we're going to look for at least 1.5 times reward versus what your risk is. So if you're risking $10, we want to potentially make about $15. Now, that is for stocks. What about options? Well, there's a lot of different types of option trades you can do, of course. When we're talking about long options, that is a long call or a long put, very often what we'll do is we'll look at the underlying stock and we will use potential movements looking at the chart for our underlying stock. On some option trades, it gets more complicated, and I'm not going to address those today. So for example, let's say we were going to do a short put vertical or something like that. We may very well be risked more than we're potentially going to gain just because it's considered to be a higher probability trade. So for today, though, we're going to focus on stock, or maybe a long call or long put here. All right? So that's our goal. And what I want to do is I want to talk about this in the context of just examples. I want to give you examples because I think that's a good way to learn. So let me give you an example here. I'm going to start off with Gilead, okay? So we just broke out of Gilead. Potential resistance level we had right here. We had earnings on this, and we broke above that. Now, if we were to say, I'm going to look to exit this trade if the stock breaks down below our support level, that presents a little bit of a problem if we only think the stock is going to go, say, to 110, because then that would probably put our reward and a risk ratio relatively equidistant. So one strategy you can use is you can look for alternative levels for your stop. In other words, instead of just using this breakout level, look what happened with this stock. It went up, and right here, it kind of formed its own little bottom right there. Let me get out of this, and let me just zoom in just to give you an idea on this trade here. I'm zooming in so you can see, and you can see the stock broke out above. It gapped up again. So it gapped up here, kind of gapped up again, and then these lows right here, these last 3 days, our lows on these last 3 days are probably they're pretty close to each other, the low on each of these last 3 days. And so what I'm going to say is, I'm going to go below this level as my stop level on this. So our support level is 104. If I go, we'll say 1% below that, I'm going to take $104 on my calculator. I'm going to multiply it by 0.99. It's going to give me a level that's 1% below that. That's going to be 102.96. That's going to be my potential stop level on this. Now, how high is this going to go? I don't know exactly, but one way we can do this is we can look and see, well, last time we moved before we had a big pullback, it went up from, about 88 up to, what is that? Just about 100, about a $12 move. So if I were to take a $12 move from this breakout point, which is commonly how we'll do that, that'd get us up to about 112. So that would give us about 112 target price. Well, let's think about this from a stock position. If the stock is at, stock is at 105.50. I may round just a little bit. And my stop is at 102.96, okay? And my target is at 112. Let's kind of figure out our reward to risk ratio. What's our potential reward here if we sell out right at that target? I'm going to take 112, I'm going to subtract 105.50, and I come up with $6.50. Okay. Now, for our risk, what's our potential risk? Realizing that that stop isn't guaranteed, I'm going to take 105.5, I'm going to subtract 102.96, and I come up with about $2.54. So that certainly exceeds the 1.5 to 1. In fact, it's actually over double. That's over a 2-to-1 reward to risk. So It may not be a trade that you want to take, but if it is one you want to do, the reward risk ratio would work out. So if you'd like to do that on paperMoney, you have my blessing to do that on paperMoney there if you want to try that out. Let's look and just look to enter that trade there. So what I'm going to do is I'm going to right click on the chart. I'm going to buy custom. That's giving me an order to buy with an OCO bracket. This is a bracket order, which is very standard with a swing trade. Remember,
well, hello, everyone. This is Barb Armstrong. Brett lost his internet, and so I am going to take over the helm here. And yeah, so appreciate your patience as we kind of isolated the problem. We've had a lot of wonderful snow coming down if you're a skier, but annoying snow coming down. This is Barb Armstrong. Oh, Brett lost his hold internet, on. And so okay, can you hear me if I do that? Okay, let me plug this in. Okay, can you guys hear me? Okay. Okay, guys, just hold on one sec. I'm getting feedback from myself. Oh, there it is. Okay, sorry. Somebody said they're tired of snow. Yeah, well, somebody is not tired of having internet service, and that would be Brent, because his went down. So guys, so glad you can all hear me. You know, as you all know, because Brent went over this at the beginning of the webcast, everything we cover here is for example purposes only. We're talking about swing trading today. So for all the people who enjoy swinging, I know I loved it as a kid. Yeah, that's our topic for today. Know that stop loss orders don't guarantee that we're going to get out at a particular price. We've got 3 or 4 stocks we want to look at. So buckle up, because we are going to be moving quickly, my friends. Okay. Okay. So let's get right over to the platform. And so here is Gilead. And I believe this was the stock that Brent was talking about when his internet service decided it was in need of a break. Just let me move this out of the way. And, you know, the line that he had drawn was here. And, you know, one of the things that he had noted was, you know, this was a resistance level. And then when earnings came out, this stock gapped up and pulled back. And, you know, he said we could look at this and, you know, put a stop below here, but we could also use this low here, the low on this day. And the low on that day was $100.83. So we could take a look at that $100.83 and multiply that by 0.97. And I'm just going to do that on my little calculator here to make it quicker. So 183 times 0.97. So we could have our stop at 97.80, you know, which is, it's still actually below this line here, you know, based on the low of this day. And then where might we want to put a target? Well, we could base our target on this flag here, you know, because it's at 105.52 right now. To just trade it back up to this 106, that's only a $1 move. But could we take this here and say, we're going to come from here, and I'm just going to duplicate this drawing and come from the base of here, and we're going to put our target up here around this 115 level. Okay, so we're going to come, and we could just do this by buying 100 shares of stock. And so we're going to buy 100 shares of stock. Could we also buy a call? We could. You know, there's a number of different trading strategies we could use, but we are going to come in here and buy 100 shares of stock at $105. We're going to put in our target of 115. So this is kind of a modified swing trade. I sound like Tweety Bird. Oh, you got to laugh at yourself sometimes, right? Even though it's a Tuesday, it feels like a Monday. And we're going to put our stop in at 97.80. And so how much are we risking here? Well, if we pay 105, we're risking, if we round up to 98, so we're risking about $7 in order to make about 950. And so if we say, well, we're okay with that kind of trade, we're going to come in, good till canceled, confirm and send. We want to buy 100 shares of Gilead. We're investing $10,000. And, there's no transaction fee associated with that. Our target is $9.46 higher, 46 cents higher than the current price. And our stop is $7.74 lower. And we are going to put this in our stocks with a target bucket. Okay. A twing trade. Yeah. Versace. Yes. Okay. And then, given, if you're not familiar with Gilead, it's in the healthcare sector. We're going to come and look at its cousin, AbbVie, ABBV. Oops. I can type, honest, I can. Okay, so, we were just talking about support and resistance in the last class, right? And, AbbVie, this $182 line seems to have played, quite a role, doesn't it? Because it was acting as a ceiling back here or a resistance level, back here. And then it acted as a support, and then it gapped down. After gapping up on earnings, it gapped down back into this range and started acting like a ceiling again. And on this most recent earnings, it gapped above, and we had a 2-day pullback, and now it's moving again to the upside. So we're at 196, and could we, place a trade and say, hey, if it goes back up around this 207, we could even make this number, 205. So let me just clear my slate here. So it doesn't have to go all the way exactly to the top. Could we make our target this previous high or the neighborhood of it? Well, here. So, on this day here, it came up to call it 205.81. Came up, I think it hit 206. It hit 206.15. So maybe we make our target here this 206. And we can show that on the right. Somebody asked, how to see your trades earlier. And if you're still on, I'll show you another way to do that once we place this trade. And so again, can we do this with stock? We can. We could also, buy an option. But, we have a $500,000 account here. So we could have a $25,000 position. So could we buy 100 shares? We could. Now, just because we have this as our swing, this is a swing trading class. So our plan will be with this to exit when it gets up to the previous high. But could a trader also put in an alert and say, hey, when it gets close to this high, we'd like to continue to own this stock because it pays a dividend, but maybe we'll sell a covered call. Like that could be another approach, right? But because we're swing traders for this 45 minutes, we are going to place in our target at 206. And where might we place an exit? Well, we could come all the way back here, and then our probability of being stopped out would be quite low. But maybe we just want to come back to this low here at 188.26 and put our stop maybe 3% below that. So actually, let's take this watch list. We'll switch that to a calculator. And so we're going to take this low on this day of 188.26. And we'll multiply that by 0.97. Because that could be considered a support level also, because buyers obviously came in there. And, it had pulled back for 2 days, and the buyer said, yeah, I'm not going to wait for it to come all the way back here. May not come all the way back. And so buyers stepped in, and then we're going to come to our trade tab. We're going to buy 100 shares. Our stop, our target is 206 based on the previous high. Now, if it gets to 205.85 and then it looks like it's going to turn around, might we change our mind and exit the trade? Absolutely. Do we do that? Absolutely. Yeah. Okay, so we want to buy 100 shares of AbbVie. We want to sell when it goes up by $9.24, or if it goes down more than $14.15, and you're saying, wow, you're risking more than you could make. And in this case, we are, but if we're looking at the probability, and how might we look at that? Well, let's put this in, and then we'll look at that. So if my stop here, March 21st, let's say my stop is between 185 and 190, it's at 188. We only have a 25% probability of it touching. If we're looking at the options at 190, we have a 25% chance of it being in the money, but we have a 50% chance of it touching 190. So, the odds at 188, we don't have a dollar wide strike here. Let's see if we have dollar wides. These are all $5 wide. But we have less than a 50% chance of being stopped out, where if our stop is tighter, the probability of it just touching it and nicking us out is higher. Now, our stop, our target is at 206. Let's see if we have a 205. So here, the probability of it coming up and hitting our target is 50% of it hitting 205. And so this is a way we can use the option chain to see the relative probability. Now these are kind of based on where the stock is currently trading. So if the stock moves up dramatically or moves down dramatically, these probabilities will change accordingly, right? Right. Okay. So that's AbbVie. Now let's go and look at AMD. And I think we just talked about AMD in the last class. In fact, I was just going to post, I have taken a screenshot of this and was about to post this on X, because we have a stock. It's gone from 227 last March 8th, all the way down. This is like a nice ski hill. I'd say this is a nice intermediate blue, right? And it's been rolling down the hill. And since it has crossed above the 30-day moving average for one whole day. That was last October. And did that turn out to be a breakout? No, it was a fake out, because it went across for one day. And then when it came back to test the ice, did it bounce? No, it fell right back below. And every time it tries to come up and break through this ceiling, technically known as a resistance level, it keeps getting rebuffed, right? And then here we are again today. And even though we're up like 0.5%, this candle pattern is indicating that this could be waning. That this could be hitting its head and about to roll over. Now, it could continue to go up. But if we looked at this and said, it looks like this downtrend is continuing, and where, if we wanted to trade bearishly, where might we put a target? Well, maybe around this 106 level. You know, our low is 106.50. And so this would be, you know, a fairly significant move. So if we looked at that and said, okay, if I buy a put, okay. Oh, sorry, I still have my drawing tools on. So we are going to put our target right here at this 106 level. We're going to make that 106. We're going to call that our swing target. And we're going to put that on the right-hand side. So now we know what we're aiming for. And we're going to buy this put today. So we want to see this on the chart. There we go. This is when we're entering this trade. We're going to come out to, now if we think, how many days did it take to come up here? Well, 1, 2, 3, 4, 5, 6 days. So how many days might it take to come down? Well, in this case here, like it took 3, took 2, 3, 1, 2, 3, 4, you know, 5, 6. So it may take 6 days. We want at least 3 weeks or 21 days plus the number of days that we're going to be in the trade. And so if we think, well, if we come out to March 21st, do we have lots of volume on the contracts? Well, on this, the 110, which is the one, you know, what we call the at the money strike, but, you know, we've got 26,000 contracts. So we are not the only people thinking puts here, my friends. We have 1,300 contracts that were traded today. And we have a 77% chance of it hitting 110. And our target, remember, was 106, right? So our target is 106. What is the probability of it coming down and hitting our target right now? Saying about 50%, 49.47. Okay. And it just has to hit it at 105. And our target's above that. So, you know, our estimate is that it would be somewhere over 50% chance of hitting that. And of course, that's not taking our superlative technical analysis into account, right? Right. And I say that a little tongue in cheek, but, you know, these probabilities don't take the trend that we're seeing on the chart into account. And that's, you know, why we do what we do, right? Okay, so we are going to sell, and, you know, in this class, you know, in a $500,000 account, we could afford to trade a couple of these, but let's say we're just going to do our single here, and we're going to put in, well, this is a swing trade, so sorry. We come in here. We are going to buy custom with an OCO bracket, and we're going to put in both our target and our stop. And so here, and both our target and our stop are going to be based, actually our target is going to be based on the price of the stock. And with a swing trade, we usually base our exit on the price of the option. So if this goes below 106, we want out, if and when. I like to speak positively, so I like to say when, but, you know, when may never happen. There is no guarantee. And then if this loses half its value, it gets to the point where it's worth about 165. So I've just taken 330 and divided it by 2. We're going to make that good till canceled. And if you're saying, well, this is a $500,000 account, we'd be willing to risk $1,000. So we could do 3 of these, right? That would be risking $990. So $990 is what we're risking. And we're going to put this in our long put group. And we're just putting in a note from us to us that this is a swing target on this trade. Okay, so fire in the hole. And remember, no guarantee. If it gaps down, we could get out for a more advantageous price, a lower price than 106. And if it really gapped up dramatically, this could trigger our exit, but we might not get out at the price we want. We could get out for less than that. So that's why we position size, being willing, position sizing based on, the fact that we could lose the entire amount. Now, somebody asked how to see the trades on the chart. I kind of like to draw it like this on the chart, but you can also come up to this sprocket. And I did type that into the chat earlier and say, just show the orders and hit apply. And we'll see the orders. Now, let's make sure when we look at this at AMD, our target is if it goes below 106. So that's where we wanted it to be. Okay, so, and when you turn that on, it comes on for everything. So you can see that our order for Gilead went in. And so when we come in here, you can see that it has our stop loss order and our target. And so can we move this up? If we wanted to move this up, we can just click and drag it, actually. It's that easy. All right. So are there some other examples that if you wanted to go out and practice this strategy, you could? We could look at Amazon, and it has pulled back. Now for today, if you're saying, well, this is breaking, this 30-day moving average, could we trade it bearishly? We could. Could we trade it bullishly? Sometimes technical analysis is in the eye of the beholder. And how about Citibank? We had done an example with 3 trades on this a short time ago. But, did this pull back and is it moving to the upside? And this wouldn't be a candidate for a swing target in that it's hitting an all-time high today. And so, but could we do a flag target on this? We could. Or could we just trend trade it? And this is a stock that pays a dividend. And, and again, no guaranteed dividends will continue to be paid, has a strong price earnings ratio. These were some of the ones that Brent Morris was going to look at today. So guys, I so appreciate your patience. As we struggled with a few technical hiccups today, I want to thank Scott Thompson for jumping into the chat and riding shotgun. I want to thank each of you for your patience. I want to thank Brent for starting off what was going to be a really awesome class, and to the guys behind the scenes who do all the technical wizardry that makes these classes run as smoothly as they do. A huge thank you. If you haven't hit the like button, if you can do that, it helps move things up in the algorithms. If you haven't subscribed to the channel already, if you could hit the subscribe button, then it makes it much easier to find this content in the future. And again, please follow Brent and I on X, Barb Armstrong CS and Brent Moore CS. That's a wrap, guys. Thanks for joining us. Bye for now.